Now we start looking at the analyzing of our data, probably one for the company as such, and compute some kind of basic ratios to see how the company has been doing over the past. So, see, the analysis wise, typically we can talk about a two-pronged analysis. The two-pronged analysis we are looking at is one is the time series analysis, typically, where you compare the values across time of one single company, or you can even call it as a cross section analysis, where for a particular period of time, for a particular point in time, you compare it across the various players, probably with the industry or with your competition or such kind of things. We are calling it as a cross section analysis. And there could be a kind of the third, which is a mix of these two, which is called as a panel analysis, or sometimes people call it as a pooled analysis, where you observe different companies across different periods of time to evaluate whether some of the numbers have gone up or gone down or anything significantly different for the company versus the industry, such kind of thing. So one common platform is, see, every year the company keeps growing. Probably the sales will keep growing every year. Now, if that's the case, okay, there is a growth, but the costs are also growing accordingly. Now, what we may have to see is profits when we look at it in terms of absolute numbers, in rupees, crores, they'll always grow. So, what is of more interest to us is in percentage terms, because the moment I convert everything into percentage, I can very well see whether something has really gone up or gone down or what is the situation. So that is what we are trying to do as a part of the common size analysis. Whenever we do a common size analysis, we are trying to convert all the numbers into percentage terms. So there are two types of common size analysis which people do. One, they put it as horizontal analysis, and one a vertical analysis. Vertical common size, whenever I say all the elements, I express it as a percentage of 100. Whereas when I do a horizontal, it's like a growth analysis. Compared to the last year, what was the growth? So they put it either in terms of percentage, or they put it as a part of the index number. So the first year they put it as an index of, let's say, 100. Second year, what is the equivalent of that? Third year, what is the equivalent of that? 120, 134, 148. So probably in 5 years, by what extent it has grown. That is what is an indexing, which you are doing in a horizontal analysis. Whereas in case of a vertical analysis, the focus is primarily on expressing everything in terms of 100%, as a percentage of either the sales or something like that. So what we can typically do, again with this data, is both for the balance sheet as well as for the income statement, we can create a simple common sizing. One for the company and probably one for the competitors also. For the competitors also, the better way is if you do this kind of same kind of analysis for each of the competitors, then it would be much better. Otherwise, what we can go forward with is assuming those numbers, whatever are pulled up, right? For the competitors, we'll make something called industry, so that we can compare the company with the industry numbers, right? So first we'll try to do it for this company itself. We'll do a time series kind of an analysis, how the numbers have been moving with respect to the past. So I'll put one another sheet for common size analysis. Where I'll take both the balance sheet as well as the income statement data directly. So I'll say equal to, I'll take the balance sheet modified. Probably I've got into the TVS Motors, but okay, whatever is the company. This is the balance sheet, or probably will take for the same Reliance itself, Bajaj Auto itself. So I'll take the balance sheet. I'll take them as it is, and I'll even take. Okay, I'll take the balance sheet as it is. We'll remove the unwanted things slightly later. So this is what I am looking at in the balance sheet, and same way I'll pull out the income statement also. Both the things I'll look at it in the same. So the income statement also I'll pull it into the same location. Okay, up to here only is the income statement existing. Now the only thing for me here is the only thing which I am trying to do in this balance sheet and the income statement is all the income statement elements I am establishing as a percentage of the sales. I'll establish each and every income statement element as a percentage of sales to see, okay, as a percentage of the total sales, whether something has gone up or gone down or what has happened. So again, I can use to enhance the process of dragging. I'll just divide whatever from sales turnover. I'll go to this income statement, the sales turnover, divide by the sales turnover itself, because every element I am dividing it by the sales. But to facilitate the process of dragging, I'll put a dollar here so that I can drag it both horizontally as well as vertically. So this process is helping me in terms of ones here, and the moment I am dragging it down, I can drag it till the last. Of course, wherever not required, I'll omit it. So the whole income statement is established in terms of percentages. I can change the format of it into the percentage format. So what I am seeing is for some of them it is not relevant. So the sales turnover, it is 100%. Excise duty, yeah, you see that the excise duties have come down drastically in the last few years. Initially they were very high. So some kind of numbers can very well be interpreted from this. Now probably some of the things which, okay, this expenditure is something which I may not do anything with because this is a heading. Okay, raw materials, power and fuel, I think we can keep all these things. Gross profit, pre-operative expenses, PBDIT, depreciation, other written-offs, EBIT, interest, profit, minority share, preference dividend, dividend tax. So from here, dividing everything by the total number of shares is dividing by the total sales is of no use. So I can remove all these elements to simplify my common size statement. Now, probably if required, I can do a plotting of all these elements to see whether in which of the areas probably my company has gone up or gone down. So some of the most important items to typically look at on these lines let's say the net profit, right? So I can plot some kind of a line graph, or probably will do for the balance sheet also and then come to it. In the balance sheet also, what I'll do is I'll express each and every item of the balance sheet as a percentage of the total assets or the total liabilities. Now, even in this case, but for some of the things it does not really matter, or there is no interpretation for us. This I am dividing by the total assets or total liabilities. Again, in this case also I will put a dollar here. Probably share capital as a percentage of the total liabilities has no meaning, because it's always fixed almost. But at least wherever there is a meaning, we can interpret it correspondingly. And I'll do the formatting of it to a percentage format. Yeah, probably these things do not really make any meaning. Share capital, because share capital is always fixed unless a new share is issued. When I divide it by when I divide it by the total liabilities, always the value keeps decreasing only, because the share capital does not change, but the liabilities keep increasing, or assets keep increasing, so the ratio will always keep decreasing. But there cannot be anything to interpret, because that value is always fixed. Wherever appropriate, probably I can talk about the total net worth as a percentage of the total liabilities. So those kind of things I can still interpret, but some of the items do not really carry any kind of a meaning. So I can typically, okay, the book value per share and all are not required for us. So book value will compute it separately, but they don't need to for a common size analysis. They are really not required. Even the checksum is not required for a common size analysis. So at least up to here, I'm deleting it. Otherwise, I may put one separator between the balance sheet and the income statement element. Now let's see. We can plot some kind of a graphs to see how it is playing a role. Now we can make the graphs as much interactive as possible. Right? Now that depends on our total graphing skills. The way we can plot our charts, we can put a drop down of all the values, and depending on what we select, the graph gets plotted for it. So those kind of automations we can very well think of doing in this entire exercise. But to start with a prime one, I can very well look at, let's say I would like to do a plotting for the PAT. I would like to do a small plotting for the PAT to see how the PAT, because as a part of this analysis, the graphing is one of the more important essential concepts, because at majority of the places, apart from the report, we'll put some interesting graphs also on how this particular element has been increasing or decreasing over a period or something like that. So I can very well, the basic way of charting this, I'll take out my, let's say I'm taking a line graph for looking at both my gross profit as well as my net profit. Let's say both of the things, right? I'm taking both PAT as well as gross profit. Let's say these two things. So I'm selecting the gross profit, the net profit, and year wise. These are the three things I'm selecting, right? Now I can go into a simple line graph. Okay, so here this line graph is by default it has plotted something. We can very well change the plotting of this, where I can go with the select data where I can say what should be my x-axis values, my x-axis values and y-axis values. For time being, I'll remove all these things. Which means I'm putting up a plain graph. What I am saying in this line graph is my x-axis values or my y-axis values. The name should be, let's say, gross profit, and the values are these five. This is one of the element. Okay. Then I am adding one more element where the name should be reported net profit and the values should be one of this, right? This is one. Now, okay, so these two are the graphs that need to be plotted for me, and the x-axis representation for me should be something like this. The March 7, 8, 9, 10, 11. Now, probably once I do a plotting for these two, okay, it is coming out that this is the gross profit. The blue one is the gross profit and the brown one represents the net profit, and more or less we are seeing the graph to be parallel. Right? I mean, if I look at one graph separately, it is saying, okay, initially the profit was much better off in 07. 8 and 9 became slightly worse years, but 10 and 11 are becoming much booming years for this company. 10 and 11, the company is doing much better in terms of the. So, but whereas if I try to plot the same with its actual numbers, not with the percentages increases or decreases, you will always see an upward moving graph itself. Majority of the time, we see that the graph will go up itself because the profit may keep increasing in terms of numbers. Because the company is growing, the profit may always be increasing itself. But that may not be a kind of a significant importance for us. So that is where we need to typically look at what is that we are targeting. Now, sometimes people want to make this graph as much automated as possible, right? Because now instead of PAT and gross profit, I may want to look at a couple of other things, right? Probably not the PAT, but instead of gross profit, I want to look something else, right? Instead of gross profit, I want to look at some other, right? Some other value. So if that is the case, it's always better to automate this part. Probably the moment I type in, instead of gross profit here, I type in some other name, that particular graph should be plotted for me. That will make the situation much more better for me. So that is where I use the different features of Excel, right? I mean, because otherwise mandatorily I have to get in and do this kind of a plot for every kind of data that has to be plotted. Probably if my intention is to look at, okay, how are the current liabilities varying, immediately I have to plot one more graph or modify the data or something like that. Rather than that, if I can drive this entire thing through the features of Excel, it can, I mean, in the same graph, it can be updated. So that is what is my target. So what I can very well do there is I can create some kind of a naming for whatever I can use, probably depending on whatever I am talking of here. Let's say the PAT or gross profit or whatever the two names which I want to use. What I can do is here I can parallelly bring in this data. There are again multiple ways of bringing in that dynamicness. Okay, so corresponding to this pat, what I'll say is no, I'll not use pat anymore here. I'll use whatever is the name exactly that is present here. Let's say reported net profit. I'll use the name exactly whatever is mentioned there. Similarly, the other one is gross profit only. Gross profit itself. Now what I'll do is I'll use VLOOKUP. I'll use VLOOKUP to bring out the values from that table there corresponding to these names. I'll use VLOOKUP to bring out those values. So I'll say VLOOKUP of, let's say, the reported net profit in this entire table. Where is the table? In this entire table, and pull out the second column wherever the match occurs. So it brings out the percentage corresponding to the net profit. Then I can drag this part to all these years where I can make it slightly dynamic. Okay. Before I drag it, I need to put appropriate dollars. So this entire region, I'll put it as dollars. And even here, I'll put H as a dollar itself. Now I'll drag it. I'll get, okay, these are the numbers I'm getting because the 2 is a fixed number. So I'll make this 2 to 3, this 2 I'll make it 4, then I'll make it 5. Even those I can automate using various other functions. Match kind of function we can use, and we can automate even that part. But just showing the way we can plot this graph dynamically, you just, now I got for the gross profit as well as for this. Now what I'll do is, instead of plotting the chart with this data, with pulling out the data, going there and pulling out the data from there, I'll update this data. Instead of pulling the data from all these locations, right, I will pull the data I'll pull the data again from this location. This is my location of the data. I'll pull the data from this location. Now you see the same graph is plotted, but the only advantage now is, instead of reported net profit here, I want to observe some other graph, probably total debt. Total debt versus the gross profit. This is what is happening to the total debt. So if the names I am using, the blue one is talking about the total debt. Now automatically, just by changing the name for it, I am getting my modified graphs plotted. Probably if you really want to make it even more interactive, you put it something like this, where even the data is, I mean, you don't need to you don't need to watch the data anytime. You can just rename these, I mean, the values. Probably you talk about the gross block. The values are automatically updated for us. So you can very well try to do the comparison, or probably you can try to bring in the industry now. You can try to see the company's values versus the industry values. If you want to see between the company and industry for for the same parameter, the same logic you can use. On one side, you do a VLOOKUP on the company's data and update those numbers. And on the other, you bring it for the industry data and update those numbers. So that's how you can use the features of Excel, the different formulas of Excel. Here VLOOKUP plays a key role in terms of bringing those kind of data and updating your data with those elements. And the common size analysis can very well be prepared. I mean, you can prepare as many charts as possible, or you don't need to prepare as many charts. The moment there is a dynamicness that is present, or even instead of this, right, you can update this with a list. So you will fill this thing, pick from a drop down list. I'll say pick this up from a drop down list. Okay, let me, I can go to this data validation. Okay, instead of any value, I can choose a list, a drop down list, and probably select the source as this entire set of values. I can select any of these entire set of values in that list. That's it. Now, even I don't need to bother about whatever is the value I would like to evaluate. Okay, I want to see current liabilities. One side I'll pull the current liabilities, on the other side I can pull whatever I want. Here I'll select from some other drop down, because here you will get the total list. Okay, I want to see how the other income is moving. Now it is showing me that the other income has fallen drastically, almost to a negative. Right, there is a loss from the other income, and now it is increased drastically, probably to 6% or something like that. So we can very well evaluate the various graphs. We don't need to plot as many graphs as possible, unless we are doing a printouts or something. We don't need to plot the different graphs. Probably we should give this kind of an interface where the person can select the values of his choice, and based on that the graphs are plotted. And in majority of the cases, what we see as a graph is the comparisons between, let's say, 2 or 3 different profitability measures. Gross profit versus net profit, or gross profit versus operating profit, or probably current assets versus current liabilities. Right, probably. So what I can very well see is, I'll see here what is the current assets, total current assets. Okay, the current assets are always higher compared to the current liabilities. One thing that is coming out. Probably I'll see the same with the competitors. And based on that, so the gap is much higher. At least in this case, we see that the current assets and the current liabilities, the gap is much higher, which could be an indicator for us that probably the company is not utilizing the cash properly. The current assets are so high compared to the current liabilities, and we are seeing that the current assets percentage is very high, probably because of that fixed deposits and the loans and advances, which we have treated them as current assets. But if I just omit those two and I just look at only the total current assets, this is what is the situation. Initial years it was lesser, but after that the current assets are much higher, which means probably the inventory or the debtors or the cash position is much higher for the company. So by doing this kind of plotting, we can very well evaluate or compare with respect to the competitors what is the kind of a position of this company in the industry. So the graphing with respect to the common size analysis is again an important aspect. right? And here you can even use, I mean, the more comfortable you are with the different features and functions of Excel, you can even bring in the dynamic graph generation by doing a named ranges, by giving the names to the ranges, or by including the offset function. If you have used the offset function of Excel, probably you can use the offset function itself to pull out the values and display. So depending on how comfortable you are in using the different features and formulas of Excel, you can do the automation here. But the end objective is probably when you are bringing in even the industry related data, the same logic you are trying to apply, right? So in the same sheet, sometime towards the right, probably you can pull up the entire industry data. You can do a comparison of the company's data with respect to the industry data. All these kind of analysis can very well be taken up, right? So it's always better to have one single type of a graph or very few set of graphs, but give them that dynamic feel. Change in the value, you observe the output accordingly, right? So that way there's a lot of flexibility in terms of why only one field. I can play around with the 20 different fields and generate my analysis accordingly. But just to see the analysis part, probably we can start with the income statement. We are seeing that the raw materials cost has gone up drastically. From 66 it has touched almost 71, 72, and slowly it has again though it has fallen, it is again on the rise, probably because of inflation. So again, we have to try to link these things to the economic parameters. So that is where, when I am doing a forecasting for the future, the regression kind of analysis will come handy for me, because I can do a kind of comparison probably between the cost versus the inflation, or the sales versus the GDP growth. So some kind of factors, because at the end of the day, the sales are growing up. There is a growth in the sales, but the growth in the sales could be because of the growth in the GDP. Just as a simple example, when you look at any typical Indian company, we see that the growth in sales would be somewhere around 10-12% at least. A good Indian company, any manufacturing, or there may be much more growth also, but the typical average growth, you see it around 10-12% minimum. But you look at any US company, probably the same competitor of Indian company itself. You look at any US company, you'll see that the growth will not be more than 4-5%. For the simple reason, because their economy is growing only at a very small percentage. The company is also growing at, because there's already developed kind of organization, countries. Developed nations, you see that the GDP growth is stable at a very marginal rate, 2%, 3%. That is the kind of a GDP growth we see. Whereas in India, we see the GDP growth at 7, 8, 9 kind of percentages every year, because it is still in a developing phase, right? So because of that, every company in the country also will grow at that same rate in terms of sales or in terms of various factors, which means GDP is playing a very significant role when I have to do the forecasting. Correct? So once I understand this analysis, the common size or ratios or whatever, they can help me in terms of doing the forecasting much better. Okay, now the costs of raw materials have differed, but they are more or less in the same range. That difference could be because of inflation. Now I'll try to see, finding out the correlation or the regression between the inflation and the raw materials cost, which can help me in terms of doing a better forecast of the economy, of the cost of goods sold and all for the future, so that I can do a better valuation for the future. Right? I can do a better valuation of the company. Then, majority of the other things, okay, the total cost of goods sold also, as we are seeing, it is varying between 70 to 76. So that itself will play a kind of, will help us in playing a what if analysis. Okay, what if the economy goes worse and the costs go to 75%? What could be the kind of value of this company? Or what could be the kind of profitability of this company? That is what is the what if analysis we typically get into. That is where the scenario and sensitivity analysis help us out with. Then, gross profit fallen but recovered drastically, and it is somewhere at around 29% right now. And probably the selling, administrative expenses and all the operating profits are in this region slightly better off. And whereas the net profit we are seeing that it is much better. Last 2 years are much better for this company in terms of the net profit. Now I may have to see and compare whether this is the same situation with only with Bajaj Auto, or the whole automobile industry itself is in this kind of a growth phase. If the whole automobile industry is in such kind of a profits, then probably automobile industry as such is good for investing. Irrespective of what company I am looking at, the automobile industry itself is a good place for investment compared to any other industry. So so that's how I look at it, as a company analysis versus an industry analysis. Whereas with respect to the industry, the numbers are not that great, whereas with the company they are much bigger. Then probably compared to the other companies within the automobile sector, I may prefer Bajaj Auto for a better investment. So that's the kind of analysis which we are looking at. Then similarly, we can look at it from the balance sheet. How are the current assets and the fixed assets? The point that needs to look at is the gross block. Only around 25 to 30% is invested in the fixed assets. Of the total assets, fixed assets are constituting a very less portion. But probably this is the manufacturing industry. The fixed assets should form a significant portion. Right? Probably if we quickly try to look at the numbers of, let's say, a Hero Honda. We'll do the industry numbers quickly, but let's say Hero Motorcorp. I want to quickly look at a number. The gross block 5,500 out of for the total liabilities we are even adding 4,400 plus the total, this one 4,400 plus 6,300, so almost 10,000, 11,000. Out of that 11,000, this is almost 5,000, almost 50%. So to the latest, the investment in the fixed assets is 50% for Hero Motorcorp, whereas Bajaj Auto is still at 30%. So they have not invested heavily in the capital. Now where are they investing heavily? Once we do the similar kind of an analysis, what is the breakup? The breakup is quite different between Hero Motorcorp, one of the leaders in this market, versus Bajaj Auto, which is also a leader in the market. Probably the market share between the two is pretty marginal. If we see, probably Hero Motorcorp is at 20,000 crores as the sales. Right? The sales of Hero Motorcorp is 20,000 crores. Whereas with respect to Bajaj Auto, it's around 10,000 crores. So probably, 17,000 crores. Almost closer. right? Whereas the other competitors are much lesser. So 20,000 and 10,000 or 17,000, 37,000 crores. Now you see TVS Motors only 7,000, much lesser than these two. Maharashtra Scooters only around 6,000 or 6 crores. Then this is of I think LML or Kinetic Motors, one of these two. So one of them is at 377 crores. Then this is one of them is of LML. That must be of LML, and this must be of uh, Kinetic Motors. It's even 0.5 crores. So not too much of sales for each of the competitors. So majorly the market is dominated by those three companies: Hero MotoCorp, TVS Motors slightly lesser, but Hero MotoCorp and Bajaj Auto, two major players in the sector. So what we can simply look at is, between these two major giants, there are major differences. At the gross block level, we are seeing a major difference. Probably at the raw material costs also we may see, okay, Hero MotoCorp is also somewhere at around 70%. 14 and by 20. Almost 70% is the cost of raw materials. Whereas even for this, it is at the same rate. Even whereas for this company, the raw materials cost is almost at 68, 69. But at some places, there may be a huge difference. And wherever there is a huge difference, it's a point of analysis. And wherever it's not, probably we can say that everything is at online with the industry itself. So that's how we evaluate different sets of numbers to arrive at our total computation. So what we can also do is, we can try computing those industry numbers by taking the same template. We can try computing those industry numbers so that we can try arriving at the par values of the industry, so that we can see with respect to industry, any company is more or less or whatever it is, right? But the common size analysis as such in a simplistic form will help us in evaluating over a time period, or we are ignoring the size, irrespective of whether the company is a big company or a small company, or whether the sales are bigger or smaller. All of them we are bringing down to the 100% mark. The moment I am expressing everything as a proportion of 100%, I can very well pull out which is the significant contributor, in which area there is a significant improvement. If we see here in the net worth, there is a significant improvement. From 30% it has reached almost the 60% mark. So 60% of the net worth is more like, your equity is much more, the debt is much lesser. Now the debt part, from 7 it has come to 2%. So this company is almost like a zero debt company. Only 2% is in the form of debt. Of the total liabilities, only 2% is in the form of debt. Again, a point to evaluate, because for a manufacturing kind of a company, we generally see that they are good at debt. They can borrow heavily because they have some capital equipment and all. They can very well borrow against that, keeping that as a collateral. Whereas this company is very low on debt. Everything provided through the equity itself. Now the same logic we can look at the industry. Whether the whole industry is like that, or only this company is going into that route. So that way, again, what is the implication of going more with debt or going more with equity? With respect to investment, right? Because our objective is with respect to the investment. Now when I look at, when there is a chance, when I am trying to look at going more with debt, obviously the cost of debt is much lesser compared to cost of equity, because the borrowing costs are always lesser compared to what the equity investor will demand as a part of the return. For a simple reason, equity investor is taking a risk, whereas a lender is not taking a big risk because every year he will get his money back. So the cost of the debt is always cheaper compared to cost of equity. So overall cost of capital for the firm is going to be much lesser. So for every rupee it is getting as a capital, what it has to pay to those investors, debt or equity investors, is lesser. Because of which probably there is a chance of its profits going up. Whereas on the other side, if the debt is more, there is a good chance of bankruptcy also. We have seen all the historical cases, including the biggest fall few years back, the Lehman Brothers. Every big fall in the finance or in the industry, all kinds of bankruptcies are just because of your heavy loans. Even the recent cases of Kingfisher, which we have been hearing for quite some time, their debt is extraordinarily higher compared to equity. If their equity was around 1,000 crores, the debt was around 7,000 crores. Now, you cannot, unless your operations are extremely profitable, you cannot think of paying off the debt. Forget about the principal. Even interest you cannot pay off, because even if you assume a 10% interest on that 7,000 crores, it is working out to 700 crores every year. Unless your profitability itself is around 700 crores every year, you cannot pay off that interest also. So that's where there is a heavy chance of bankruptcy. The more and more you are going heavy into debts, 1 or 2 bad years, the same thing happened for that airline company, right? 2 or 3 bad years, until a point in time, as long as the economy was good, no issue at all, or probably it was treated as one of the king airlines, right? But 2 or 3 years of bad economy, or bad economy followed by even more badness, has exploited all the debts which this sector has, which this company has, compared to its competitors. So the more and more debt you are taking, so the consequences of that you are typically looking at. So the best thing to look at is compare each and every number of each and every company with respect to its competitors and with respect to the industry average. Wherever there is a significant difference, that is where we have to dig deeper and start analyzing what could have contributed to that difference, right? So we'll quickly summarize the industry numbers to see where the deviations are significantly different between this company and the industry. And at the end, what we are seeing is industry is nothing but those 3 companies itself. So probably even we can look at those 3, or we can add up all the companies, either way. But that is the industry. If we are looking at that is the industry, what are the typical numbers? We can quickly do some kind of calculations on that and try to arrive at the industry numbers for it.